Somewhere in Denver right now, a couple named Derek and Amanda are staring at a grocery receipt that feels wrong, even though every line item checks out. Derek works as an HVAC technician. Amanda manages a small bakery near their neighborhood. Neither of them follows monetary policy for fun, but both of them have started asking the same question millions of Americans are quietly asking in 2026. Where does money actually come from, and what happens if the people in charge of creating it simply decide to create a lot more of it? It sounds like a fantasy solution. Wipe out poverty. As of mid-2026, the total gross national debt of the United States sits close to $39. $7 trillion according to Treasury data, a figure that works out to roughly $118,000 for every single American citizen, and one that's been climbing by about $1. $3 billion every single day. That debt doesn't just sit there quietly. It costs money to carry. The federal government is now paying around $1 trillion a year in net interest payments alone, a figure the Congressional Budget Office expects to balloon to roughly $2. $1 trillion annually by 2036, and interest is already a bigger line item in the federal budget than either Medicare or Medicaid. Put another way, about 39 cents of every dollar Americans pay in individual income taxes now goes toward interest on debt already spent. Not toward paying down the debt itself, just toward covering the interest on it. That's the backdrop against which every conversation about just print more money is actually happening. So imagine, for a moment, that Washington genuinely tried it. Not a modest stimulus check, but the full fantasy. The Federal Reserve creating money without real limit, using it to cover the debt, fund infrastructure, and hand out generous payments to every household. For Derek and Amanda, the first few months would probably feel like a windfall. Bigger direct deposits, government contracts flowing into Derek's company for infrastructure work. Amanda's bakery packed every morning because people suddenly have more cash sitting in their checking accounts than they know what to do with. Stocks would likely rally hard because a flood of new money chasing the same pool of assets tends to push prices up before it pushes anything else up. For a little while, it would genuinely look like the government had found the cheat code. Then the machinery of real economics starts to grind against the fantasy. Money is a claim on goods and services, but it isn't the goods and services themselves. Derek's employer can't magically train twice as many technicians overnight. Amanda's bakery can't triple its oven capacity in a weekend. Home construction, food production, healthcare capacity. None of it scales instantly just because more dollars exist to chase it. When the number of dollars in circulation grows dramatically faster than the actual output of the economy, you get exactly what economists have described for 2 centuries. More money chasing the same amount of stuff, prices rise. Not because anything got scarcer, but because the currency measuring its value got more abundant. This is where the debate actually gets interesting, because economists don't agree on how automatic that outcome is. There's a real live disagreement in 2026 between what's sometimes called the monetarist view and the more mainstream Keynesian-influenced view the Fed itself tends to operate from. Monetarists point out that before the 2008 financial crisis, banks held only about $50 billion in required reserves and roughly $6 billion in excess reserves. Figures that later exploded into the trillions after repeated rounds of quantitative easing, and they've long worried that such enormous increases in the money supply eventually show up as equally enormous inflation. But even modern monetarists concede that the Fed retains real tools to reverse course. It can raise the interest rate it pays on reserves, effectively turning idle cash back into interest-bearing government debt, and it can sell off the trillions in bonds still sitting on its balance sheet. The genuine worry isn't that money creation makes inflation mathematically unavoidable. It's whether the Fed acts fast enough and whether it's still independent enough to want to. That second half of the sentence, independence, is not an abstract worry either. It's an active storyline in 2026. Political pressure on the Federal Reserve to cut interest rates faster has been a live concern throughout the past year, and the Fed got a new chair, Kevin Warsh, in mid-2026. In his first press conference, Warsh reportedly said the committee was unanimous and unambiguous in its commitment to fighting inflation, mentioning price stability a dozen times, a level of repetition that tells you exactly what he was trying to reassure markets about. Economists have a specific term for the danger scenario here: fiscal dominance, which is what happens when a government's finances become so stretched that it effectively forces the central bank to finance deficits through money creation, rather than letting monetary policy operate independently to control prices. Every serious hyperinflation in modern history shares this exact fingerprint. Weimar Germany faced unpayable war reparations. Zimbabwe's government spent far beyond its means after its agricultural exports collapsed. Venezuela kept enormous subsidies and public payrolls running, even as oil revenue collapsed by 70%. In each case, the central bank stopped being a referee and became a subsidiary of the government's spending habit. The Weimar case is worth sitting with for a moment because the numbers are almost impossible to believe until you see them written down. Before the First World War, it took a little over 4 German marks to buy one US dollar. By July 1922, prices had already risen 700%. By the end of 1923, one US dollar was worth 1 trillion marks. People famously described ordering a cup of coffee, only to find the price had gone up again by the time they finished drinking it. Zimbabwe told a similar story 8 decades later. Inflation there started at an already alarming 57% in 1999 and eventually reached a documented peak of 231 million percent year over year by 2008. Venezuela's collapse is the most recent and, in some ways, the most instructive, because it happened inside a modern oil-rich economy that most people assumed was too developed for this kind of thing. Venezuela's hyperinflation peaked around 374% in 2018, driven by a government that kept printing bolivars to cover spending commitments even as the productive economy underneath it was shrinking. Here's the detail that gets lost in most retellings of these stories, and it matters enormously for how worried Americans should actually be right now. Hyperinflation, the truly catastrophic kind, has never simply been a matter of a government deciding to print more money for the fun of it. A widely cited Cato Institute study reviewing all 56 documented cases of hyperinflation in modern history found that they only occur under extreme conditions, typically war or complete collapse in a country's underlying productive capacity, not as a routine consequence of ordinary monetary policy. Every case involved a country whose actual ability to produce goods and services had already broken down, forcing the government to paper over that collapse with currency instead of real output. That's an important nuance, because it means the printing money always ends in Weimar-style collapse. Framing that circulates online is a little too simple. It also means the actual danger for a country like the United States isn't primarily about the money supply number in isolation. It's about whether the underlying economy, the debt trajectory, and the political will to say no to more spending are drifting toward that same fiscal dominance trap. And there are signs that trajectory deserves real attention, even short of anything resembling Weimar or Zimbabwe. The Federal Reserve's own balance sheet tells part of the story. When quantitative easing began during the 2008 financial crisis, the balance sheet stood around $900 billion. After 3 rounds of QE, it had exploded past $4, $5 trillion, and by the time pandemic-era stimulus ran its course, it had ballooned to nearly $9 trillion. In late 2025, the Fed announced it would end its balance sheet reduction and, within weeks, quietly restarted outright asset purchases, buying billions in short-term treasury bills in what commentators have described as a soft, unofficial return to a version of debt monetization even without ever using that phrase publicly. Meanwhile, the Treasury itself has been buying back tens of billions in older bonds using proceeds from new short-term debt, a maneuver that shortens the average maturity of outstanding government debt and quietly suppresses long-term borrowing costs, which some analysts have bluntly compared to a Ponzi-style shuffling of obligations rather than an actual solution to the underlying deficit. Derek and Amanda wouldn't see any of that directly. What they'd see, in the scenario where money creation genuinely ran unchecked, is a grocery bill that keeps climbing every single week without ever leveling off, the exact pattern known as a wage price spiral. Workers, watching their paychecks buy less each month, demand raises to keep up. Employers grant the raises, then raise their own prices to cover the higher payroll costs. Those higher prices push workers to demand the next round of raises. Once that cycle takes hold, it becomes genuinely difficult to break without deliberately slowing the entire economy down, which is precisely why interest rate hikes, when they eventually come, tend to be so painful. They're not incidental collateral damage. They're the tool designed to break the cycle. And breaking a cycle that's already spinning usually means throttling growth and often throwing people out of work in the short term as the price of stopping the bigger problem. There's a currency confidence dimension to this too, and it's playing out on the world stage right now in a way that would have seemed unthinkable a decade ago. In the first quarter of 2026 alone, the US dollar's share of global central bank reserves fell by roughly 3 percentage points, down to about 56. 1%, a decline that historically took 2 to 3 years, compressed into 3 months. Total dollar-denominated reserves held by central banks fell by roughly $340 billion, even as total global reserves rose, meaning central banks were actively selling dollars and buying something else. That something else, overwhelmingly, has been gold. The World Gold Council recorded 420 tons of central bank gold purchases in the first quarter of 2026 alone, shattering the previous quarterly record, and global central bank gold buying for the full year is on pace to exceed 1,600 tons, more than double the average annual pace between 2015 and 2020. Gold's overall share of global foreign reserves has climbed from around 13% in 2017 to roughly 30% by late 2025. Central banks buy gold for a specific, almost defensive reason. Gold cannot be frozen by sanctions, cannot be devalued by a foreign country's monetary policy, and cannot be excluded from any payment network. Qualities that have become far more valuable to nervous reserve managers since dollar-based financial infrastructure started getting used as a geopolitical weapon. None of this means the dollar is about to collapse overnight, and it's worth being precise about what the actual research shows rather than the more dramatic headlines built on top of it. One Federal Reserve staff study looking closely at the data found something more nuanced than a simple story of mass dollar abandonment. Gold reserve accumulation at the level of individual countries is generally not associated with broader de-dollarization except in a small number of prominent cases, mainly Russia and Turkey, while most countries buying gold appear to be pursuing modest diversification rather than a deliberate exit from the dollar. The dollar remains, by a wide margin, the world's dominant reserve and transaction currency. But the direction of travel is unmistakable, and it has accelerated. Historical precedent offers a sobering comparison for how these transitions actually unfold. The British pound's share of global reserves fell from around 80% in 1913 to under 10% by 1970, not through sudden collapse, but through 5 decades of gradual erosion as confidence slowly shifted elsewhere. If the dollar is on a similar arc, nobody involved expects it to happen as a single dramatic headline. They expect it to happen the way most currency transitions happen historically, slowly and then all at once toward the end. What would that actually mean for a family like Derek and Amanda's, in practical terms rather than headline terms? A weaker dollar makes imported goods more expensive, everything from electronics to medication that relies on components sourced overseas. It also tends to push interest rates upward as lenders demand more compensation for the risk of holding dollar-denominated debt whose future value looks less certain. That shows up directly in mortgage rates and the cost of financing a car, in the interest a small business like Amanda's Bakery pays on a loan to replace an oven. Higher borrowing costs slow investment even while the money supply itself is technically abundant, which is exactly the uncomfortable, counterintuitive part of this whole story. You can have too much money in circulation and simultaneously have credit that's expensive and hard to get, because the two problems, inflation and borrowing costs, feed off each other rather than canceling each other out. There's also a wealth distribution angle to unlimited money creation that rarely gets discussed honestly, and it's not politically neutral in its effects, even when the policy itself is framed as helping everyone equally. Economists sometimes call the result of sustained inflation an inflation tax, and it doesn't fall evenly. People holding fixed-rate debt actually benefit somewhat because they're repaying loans with dollars that are worth less than the dollars they originally borrowed. But people living on fixed incomes, retirees on pensions, workers whose wages lag behind price increases, anyone holding cash savings rather than assets like real estate or stocks that tend to rise with inflation, lose real purchasing power in a way that's very difficult to recover from. Recent US economic data shows exactly this kind of split forming. Higher income households have largely maintained their spending levels even amid inflation and job market softness, while lower income households increasingly rely on debt to keep up, with delinquency rates on things like auto loans already ticking upward as an early warning sign. Money creation, in other words, doesn't hit a country evenly. It tends to widen exactly the gap between people with real assets and people without them. So why doesn't every country simply avoid this trap entirely? Partly because, in a genuine crisis, the alternative to some money creation can be worse. During the depths of the 2008 financial crisis, and again during the COVID-19 pandemic, mainstream economists broadly agreed that the risk of a severe deflationary depression, where economic activity collapses and keeps collapsing, outweighed the risk of the inflation that resulted from injecting massive liquidity into the system. Deflation is its own kind of monster. Falling prices sound pleasant until you realize they mean falling wages, canceled orders, and a self-reinforcing spiral where nobody wants to spend today because everything will be cheaper tomorrow. The genuinely hard part of monetary policy isn't choosing between print money and don't as a permanent stance. It's knowing precisely when an emergency justifies temporary expansion, and then having the discipline to actually reverse it once the emergency passes. Historically, that second half, the reversal, is where governments consistently struggle. The Fed's brief 2017-2019 attempt to shrink its post-2008 balance sheet ended within about a year, once markets wobbled and the stock market stumbled in late 2018, and the balance sheet was expanding again before the pandemic even arrived to provide a fresh excuse. Consider the current fiscal picture through that lens, because it's genuinely more precarious than most people realize, even without any dramatic, unlimited printing scenario ever actually happening. The Committee for a Responsible Federal Budget has outlined what a full-blown fiscal crisis could look like. The government or Federal Reserve directly or indirectly monetizing the debt, using newly created money to cover interest and principal payments, rather than relying on outside buyers of Treasury securities. Even just the fear that this might happen, without it actually happening yet, can be enough to de-anchor inflation expectations, as investors start pricing in future inflation risk today, demanding higher interest rates as compensation, which in turn makes the government's own borrowing costs worse and pushes the situation closer to the very crisis everyone was trying to avoid. It's a genuinely unstable feedback loop. The fear of inflation can itself become a cause of inflation, entirely independent of whether the Fed actually does anything differently. To be fair to the more optimistic economists in this debate, there's a competing school of thought, sometimes associated with modern monetary theory, that argues a country borrowing in its own currency, with its own central bank, faces fundamentally different constraints than a household or even a country like Venezuela borrowing in a currency it doesn't control. Proponents of this view argue that the real limit on government spending isn't the number of dollars available, but real resources, the actual capacity of the economy to produce goods, labor, and services without triggering inflation. Critics of this view respond that the United States is precisely testing that theory in real time right now, given how far both the debt level and the balance sheet have already stretched relative to history, and that the dollar's slipping reserve currency status is exactly the kind of early warning signal that theory has the least good answer for. What almost every economist across this spectrum agrees on, whether they lean monetarist, Keynesian, or MMT adjacent, is the deeper point that closes out both the historical case studies and the modern data. Money itself has no inherent value. A dollar bill is a printed promise, not a stored unit of wealth. Its entire worth depends on a shared, ongoing belief that other people will accept it tomorrow in exchange for something real: food, labor, shelter, energy. Across every hyperinflation case study from 1920s Germany to 2000s, Zimbabwe to 2010s, Venezuela, the pattern was remarkably consistent. Governments printed money to cover debts and deficits, public confidence eventually evaporated, and citizens watched years of savings become worthless in a matter of months. Gold, land, functioning businesses, and useful skills held their value throughout every one of those collapses precisely because their worth doesn't depend on anyone's continued faith in a government's promises. Currency is different. Currency is faith, formalized into paper or these days into numbers on a banking app. That's ultimately the lesson buried underneath every version of the "what if we just printed unlimited money" thought experiment. It isn't really a question about mechanics. The Federal Reserve absolutely has the technical ability to create as many dollars as it wants, with a few keystrokes at any time. The real question was never whether it's possible. It's whether doing so actually creates anything of lasting value, or whether it just redistributes existing value quietly and often, regressively, from savers to spenders, from fixed incomes to asset owners, from tomorrow's stability to today's temporary relief. Real wealth, food that gets grown, houses that get built, medicine that gets manufactured, skills that get developed, comes from production, not from a printing press. A government can create unlimited units of currency. It cannot create unlimited units of the things that currency is supposed to represent. It's worth being specific about what's actually driving inflation risk in the U.S. economy right now in 2026, rather than treating money printing as the only variable in the equation, because the picture on the ground is more tangled than a single cause. At its late April 2026 meeting, the Federal Open Market Committee held its target rate steady in a range of 5 to 3, 75%. And minutes from that meeting show policymakers weighing a very specific worry: that a conflict in the Middle East, combined with tariffs, could push energy prices and import costs up in a way that becomes embedded more broadly in the economy, potentially de-anchoring longer-term inflation expectations, rather than fading on its own. That's a genuinely different inflation risk than pure money supply growth. It's a supply-side shock layered on top of an already stretched fiscal picture, and the two interact in an ugly way. When energy and import prices rise for reasons that have nothing to do with the money supply, and the government's response is to borrow and spend more to cushion the impact rather than let the economy absorb the shock, you get a version of the same wage-price dynamic described earlier, just triggered from a different direction. This isn't a new pattern for the American economy either. It happened before, most famously in the 1970s, and the parallels are close enough that economists at the Fed reference that period constantly when discussing the current moment. Back then, oil price shocks from the Middle East combined with loose monetary policy to produce a decade of stubborn, embedded inflation that proved brutally difficult to unwind. It eventually took the Federal Reserve, under Chairman Paul Volcker, pushing interest rates above 19% and deliberately inducing a sharp recession to finally break the inflationary psychology that had taken hold. That's the actual historical cost of letting a wage price spiral run for too long before acting. Not a clever policy adjustment, but years of painful, deliberately engineered economic slowdown to undo the damage. It's part of why current Fed officials talk so insistently about inflation expectations staying anchored. Once the public and businesses genuinely believe prices will keep rising and start planning around that belief, unwinding it becomes exponentially harder than preventing it in the first place. There's also a market-level risk sitting on top of all of this that connects directly back to the debt and confidence questions. Moody's Analytics, modeling several macroeconomic scenarios for how the current mix of high government debt, elevated asset valuations, and heavy corporate borrowing could play out, assigns real probability to a scenario where investor enthusiasm around highly valued sectors of the market cools faster than expected, triggering a severe sell-off, similar in shape, if not necessarily in scale, to the bursting of the dot-com bubble a quarter century ago, with the resulting hit to household wealth undermining consumer spending, roiling credit markets, and pushing highly leveraged companies into distress as they struggle to manage debt taken on during the boom. The uncomfortable link back to monetary policy is this. A market shock of that kind puts enormous political pressure on the Federal Reserve to cut rates fast and support asset prices, exactly the kind of pressure that, if acted on too aggressively, risks reigniting the inflation the Fed spent years trying to tame. Every lever policymakers can pull to cushion one kind of pain tends to increase exposure to the other kind. There's no move in this environment that comes free. None of this is meant to induce panic, and it's worth saying plainly that the mainstream, most likely outcome according to most forecasters, isn't hyperinflation, isn't a dollar collapse, and isn't a 1920s Germany scenario playing out in Denver or anywhere else in America. Recent labor market data actually shows some stabilization. Private employers added an average of about 117,000 jobs per month through the first part of 2026, up sharply from an average closer to 10,000 per month in 2025, and unemployment has held in a relatively narrow band. The realistic risk isn't sudden collapse. It's a slower, grindier erosion. Elevated prices that stay stubbornly above target for longer than officials would like, a debt load that keeps consuming a larger share of the federal budget every year, a currency that keeps losing a little reserve status ground every quarter, and a Federal Reserve that has to keep threading an increasingly narrow needle between supporting growth and preventing the kind of embedded, self-reinforcing inflation that becomes genuinely hard to undo. That's a less cinematic story than hyperinflation, but for an ordinary household, it's arguably the more relevant one because it's the one actually unfolding in real time rather than the one confined to history books and worst-case model runs. So what does any of this actually mean for a household like Derek and Amanda's trying to make sensible decisions rather than panic-driven ones? The historical and current data point toward a few unglamorous, consistent lessons rather than a single dramatic move. Debt that's fixed rate and tied to a real productive asset, a home, a piece of equipment for the bakery, tends to become easier to manage in real terms during periods of sustained inflation, since it gets repaid in currency that's worth less than it used to be. Cash, sitting idle by contrast, is the asset that erodes fastest and most silently. It's the one category almost every hyperinflation case study singles out as the worst place to be parked when confidence in a currency starts slipping. Real productive skills and ownership stakes in things that generate actual goods or services, a functioning business, a trade, an income-producing asset, have held value across every currency collapse in the historical record in a way that pure paper savings never have. None of that is exotic advice. It's the same conclusion households have been arriving at for a century, across wildly different countries and wildly different political systems, which is itself part of the point. The pattern repeats because the underlying economics don't actually change, even when the specific circumstances around them do. For Derek and Amanda, the honest, unglamorous conclusion sitting underneath all of this data is something closer to what previous generations already learned the hard way and keep having to relearn. Currency works because people trust it. Debt matters because someone eventually has to service it. And there's no clever policy shortcut that lets a country consume more real goods and services than it actually produces without consequences showing up somewhere. In prices, in interest rates, in the exchange rate, or in the currency's long-term credibility on the world stage. The Federal Reserve, whoever sits in the chair's office, will keep walking a genuinely difficult line in the years ahead. Enough monetary support to avoid a damaging recession, but not so much that it reignites the kind of inflation that quietly erodes a family's savings and a country's credibility one grocery bill at a time. History doesn't say that balance is impossible to strike. It says, fairly bluntly, that it's a lot harder to walk back than it ever looks going in, and that every government that has ever assumed it was the exception to that rule has eventually discovered in one way or another that it wasn't.